Good morning, everybody. So I've got a bit of news this morning. Richard's got some news as well. And then I'm going to be talking to Joe Boyfriend from AVI Global Trust. So news first. So the two bits that I'm going to be talking about are Digital 9 and Herald. And then I'm going to hand over to Richard for a bit into about Tritax and Tritax REIT. I want to start with Digital 9. Obviously, this has been a disaster and we all know that. But it's still quite a big company because we forget how much money this company raised back in the day. And it's trading on an enormous discount, about 70%. That's actually not to a current NAV, as we'll show in a second. And the old dividend is way gone. In terms of what's been going on recently, in December, we got a new manager finally in place, although it's been involved for a while now. So what's going on with the portfolio isn't directly because Infrared is taking charge. And what we have got, though, is a couple of disposals. The first of those happened right at the end of the year, normally in places of very bad news, and they sold their undersea cable investment, EMIC, which is trying to run the cable basically from Europe to India, and it had to go through the Red Sea. And the Yemeni problems down there meant that basically the construction couldn't be completed. They've sold it for less than it was valued at the end of June. It took about off the NAV, but it did free them up from commitments that they had to future construction costs. So that's obviously very good news. It did actually bring in some cash. So that cash is going to come in relatively quickly in March 2025. So that's all really, even though it looked like quite very news at the time. But this latest disposal looks like a complete disaster. EMIC was a sort of side sheet of this thing, Aquacomms, and it's quite a big investment for Digital 9. They originally invested £170 million in it in 2020, and I think they've committed more money to it since. By the end of December 2023, you can see it was valued at £283 million. They wrote that down enormously in June, and I think we talked about it at the time, down to £75 million. And we thought, well, that's dreadful. That must be kitchen sink. But actually, the price that they got for it was only 48, which is, disaster. In terms of what's been sold, owns 3 transatlantic cables and 2 UK island cables, and has some exposure to a UK-Europe one as well. All of these are operational, so all of them are already earning money. And so you'd think that then there's a little room for it to be sort of a disaster. The other thing is, it's going to take about 12 months to complete this. So we're going to have to hang around for the money. All in all, really not bad news and a good reason for the share price to dive. Well, the reason that it wrote the value down in June was because it was planning to build a whole bunch of stuff in Asia. And then it turned around and said, realistically, we've got all this value for that, but there's no way that we can fund that. So that's not going to happen. So we've got all this stuff in the NAV. I'm amazed that it was so badly misvalued, that they had that much value in there for a project that they couldn't fund. But that was due to the issue, really. But it does speak to the poor quality of the management team and the board, both of which have been replaced. The money that they were earning on the transatlantic route has been going down quite a lot, and they're saying 15% per annum over the past 5 years. Now, the real damning thing about this is it meant that that had already been happening for a couple of years when they bought it. So God knows why they paid so much money for it. I guess maybe they bought it for the growth in Asia, but still, nevertheless, this is pretty bad. It doesn't look very good. They also acknowledge that higher interest rates are effective valuations, which is something that we go in and around with the whole infrastructure and renewable energy sector. Quite often managers saying, no, that's not an issue. But here, definitely it is the case. And I think that's because it's a sort of cash generative but low growth business that is just priced off what the cash flows are going to be rather than any kind of hope value. So there's a new NAV being calculated. We're looking at an NAV now at about 42.6p once you've taken off the adjustments of these disposals. I wouldn't be surprised if it comes down again, but we probably won't know that until April. In terms of what it's got left, so there's a wireless broadband business in Dublin, which is okay, but not very big. There's a facility at the end of a cable in Newcastle that connects UK and Denmark. That's smaller again. And then the big thing is the broadcast towers for TV and radio. And obviously, as we switch more and more to digital TV and to satellite TV, the use for those is kind of going down. And so that puts a big question mark over their value. and they're financed by a lot of debt. So that's another question mark again. It has got a smart metering platform covering 12 million premises, and smart meters are still a growing thing, and they're still investing in that. And that might be where there's still some value, but it's going to be interesting to see what infrared does with valuation. So there's some other wrinkles around this as well. It's got inflation linked in the structure, which is not great. We'll see what's going on with inflation. There's also some vendor loan notes. So when they bought it, they basically structured it with this debt base. That means they owe the seller that they bought it from £163 million. They're not paying the interest on that. That's rolling up within it. So that's another 17 million. Interest rate's going to go up because I think the original plan was to pay that vendor loan note off definitely before the interest rate starts going up in June, but that goes every year then by 1%, and then they have to pay the money back until 2029. So that all is a complication that's going to affect how much they can get for it. But it is, it's a chunky business, 350 million revenue, 47% margin. It's not a bad business like that. But obviously, the problem is how long will that income stream keep going? The other unknown with all of this is the third process they've got from Verne Global, but that's based on what that business does over the year ending 31st December 2026. So we won't know how much that's going to be until 2027. Basically, what we're saying is we've had a couple of disasters. The Elio and CH are probably neither here nor there. It's all going to hinge on what value for Arqiva is. And I think it's understandable that it's trading at such a big discount. Now, Herald obviously amazing news, but I just wanted to flag up what's going on since. So obviously the share price has been coming off since Saba lost the vote, or even anticipation of that, really. So let's talk about that. It was a great result, and we're really pleased. 80% of the shareholders turned out and voted. To be honest, I'd still like to know why the other 20% didn't. I do think this is such an important thing that it was not something that you could really choose to ignore. And I wonder to what extent it was problems with voting. They say that you didn't get notified in time, or your platform made it very difficult, or your platform tried to charge you. All those things. I'd be really interested to know if there was an issue with you wanted to vote and you couldn't. So please message me if that's the case. But nevertheless, good results. We won 65-35. Only 60,000 shares voted with Saba. That's a tiny, tiny amount, and it just really quite demonstrates just how much people don't like the idea. I'm hoping to see a similar sort of pattern with the other votes as well. In terms of what happens now, there's no obligation on the company to tackle the Saba position straight away. They have sort of hinted that we were buying back stock before. Probably we'll go back doing that. We're going to look at, the allocations of capital and things. There's definitely, to my mind, no mileage in giving Saba any kind of exit NAV. It'll just encourage you to come back and go do it again. It's quite funny that another US hedge fund has come in and has started shorting the shares. So basically, it was shorting the shares when they were trading at asset value, which we know was sustainable and not natural anyway. And so that 0.5% short is one of the reasons why that discount's widened out. Now, just thinking about Saba, had a 10% position is. Start again. The discount Herald was about 10% back in August, but then it started to narrow in from about the beginning of November. Saba was buying stock all the way through actually at the beginning of November, and it then accelerated that buying. So it bought about another £1.5 million or £34 million worth over the next few weeks, and that's what drove the discount into low single digits. And then it said it had 18.5% of Herald when it repositioned it, although only 3% was Jerusalem's name. The rest was held through these sort of stock swaps with big brokers like Jefferies and Barclays. And so it had already bought within that quite a chunk of stock and fairly narrow discounts that really were unlikely to persist if it was to vote. But then it went all out and spent another, I reckon, £130 million buying another 5.3 million shares, more or less around asset values, sometimes at premiums. And it's using clients' money to do that. There's no logical way that makes sense for those clients, because they're almost guaranteed to lose money. Even if you just liquidate the portfolio straight away and somehow magically you've got NAV for it, you're still probably going to lose money on it. So it just demonstrates they've just spent 130 million clients me trying to win a vote so that they can get more assets under management and earn more management fees. The idea that anybody would want to be invested in this Saba fund that's closing discounts for a living is just beyond me. And now that they've lost this, and it's looking like there's no way back, although there are some other votes coming up, Herald, that we need to make sure we went to, how will they be and where will the discount go to? I think that's going to be quite interesting to watch. So I wouldn't be surprised if that discount widens again. So it's about 8.75 now. It could go into double digits. By the time you start getting down towards where the 15% normally trades again, you definitely think about buying that own stock or to itself. I just want to reiterate that you make sure you do vote in the other fights. There is a concern among some of the advisors that the turnout for those is going to be a lot lower. And so the margin of victory is going to be much tighter. So it is very important you do vote. You can't read this. This is on our website. But just to remind you that the votes, the next batch of votes from the 3rd, 4th, and 5th, with Edward Worldwide out 10 days after that. The 3rd, 4th, and 5th ones, you really have to be thinking about voting today and Monday just to be absolutely sure you get your votes in. So please do that. It is very important. So I'm going to hand over to Richard.
Thanks, James. Yeah, a couple of really interesting real estate stories this week. Firstly, Tritax Big Box. As the chart shows here, its discount started to widen at the end of 22 when interest rates rose, but started to come back back in the last year, and then obviously the budget boshed up, and it's back out at a sort of 20% discount now. But on the next slide, they've made a really interesting acquisition this week. So they bought a site near Heathrow, and they're going to develop a data center. So they're going really big on data centers now, which is a play on sort of AI and AI infrastructure. And we've obviously seen it booming in the US, and that's going to follow over here. So they bought this initial site near Heathrow, and the phase one is going to be 107 megawatt scheme, which is huge. It make it the biggest data center in the UK. But it's going to cost 365 million, including all the sort of land purchase, development, and all that kind of stuff. And this is just CGI of it, and it looks exactly like what they're developing now on the logistics side, because it pretty much is. The only real difference really is the power side. So, which is interesting with this deal, we see on the next slide, they've entered a JV with a power supply company that will bring all the power to this site that they need in a sort of accelerated period. So normally they'd have to apply to the grid, and that can take up to 10 years, they're saying. But through this sort of JV that they've entered into, they will get that so much quicker and get it online quicker, which obviously is much better for them, getting tenants on board and rent and things like that. And so this JV is really crucial to their plans, I believe. And they made this purchase through their manager, Tritax Management. So they've had for 10 years the team working exclusively on power and with this in mind, I think, and they built up this big pipeline. And now Tritax Big Box has come in and bought that stake out of the JV with the renewable energy provider, and it's given them a big sort of platform in which to grow this business. So on the next slide, we'll see the pipeline that they've got throughout the UK, which is up to 1 gigawatt. So it's going to be absolutely huge. If we see on the next slide, so yeah, the pipeline, like I said, one gigawatt was huge. Further opportunities across the UK, mainly in the southeast and the Midlands, and they'll look to sort of get these going from 2028 onwards. And the Big Box has the first right of refusal on this, so it's Tritax Management that owns the rights to these sites, and Big Box will have first right to refusal on them when they come up. And it would make Big Box the largest data centre operator in the UK by a long, long way. So it's really exciting stuff for them. And it's exciting because of the demand side. So we see on the next slide, the sort of fundamentals. So the one after this, there we go. The fundamentals for the sector are huge. So we're looking at sort of growth of 22% annually over the next 5 to 7 years because of the demand side, basically. On the next slide, we'll go into sort of where that demand is coming from. So the hyperscalers have announced so far that there's about £25 billion of capex on data centres in the UK. Like I said, 2% annually demand growth from 2023 to 2030. And there's a massive shortage of supply for this stuff, like there is in the logistics sector, but even more so here because of the power side of things. Getting the power to these data centers is the biggest constraint there is. And so this JV that they've got tied up is a massive benefit for them, and can get these on site quicker and operational quicker, and obviously then rents coming through quicker. And we saw on previous slide that this one is a yield on cost of 9.3%. They're targeting between 8 and 10% yield on costs, which compares to the yield on cost on their logistics developments, which are between 6 and 8%. And then when these data centers are operational and stabilized, the yield on those drops to about 5%. So you can really see the investment uplift, valuation lift that they'll get once these are built and then operation. And another interesting point is that data centers have been classified as critical national infrastructure now in the UK. So all looking good for them. So onto social housing REIT now. A lot of smaller companies, they've having troubles over the last few years with a couple of tenants that are sort of non-performing. And then we had the short seller attack on Civitas a few years ago. And then it got caught up with the home REIT stuff unfairly because it's two completely different sectors. But there you go. But they recently given the management contract to Atrato, which took over the 1st of this month. So they've been in seat for about 3 weeks now. And we went to see them a couple of weeks ago, and it does look promising that they'll get this turned around. But one of the problem troubles they got at the moment is, as we see on the next slide, is one of their tenants, MySpace, is having quite substantial financial difficulties, hasn't paid any rent for the last sort of 6 months or anything. So they're looking to sort that out. So we go back by proposing a change to their investment policy. So they're looking to increase the maximum exposure that they can have to any one provider to 35% from the current 30%, and then bringing a limit on the top 2 providers to not exceed 55%. They also talked about removing a commitment not to seek disposal. So you can probably see that there's going to be some portfolio sales coming up. The meeting to vote on this is on the 10th of Feb. So as I was saying about the MySpace, they've not paid any rent for 6 months. As we see on the next slide, we can see the detail here. So they're quite a big tenant for them. So 8.1% of annual rent roll to this. So it's sizable. They need to get this sorted. But it's not as easy as just transferring over to a new provider like they did with Parasol last year, which is another tenant that was in difficulties, because the MySpace portfolio has some of the properties on there. They provide services to care for the residents, which is not normally the case with this stuff. So these have to be out, and they're normally outsourced to a care provider, but not in these cases. So this limits the amount of potential providers that they could transfer these leases over to, which is why they want to increase the concentration onto up to 35% on one tenant. That obviously brings in concentration risk, but their argument is that actually they're going to have fewer but higher quality providers, which actually makes sense in this space, as we've seen over the last sort of 5-10 years. Some of the smaller guys are just not worth having on your rent roll. So to have a narrower concentration on the higher qualities makes sense to us. And like I said earlier, the new management team, they seem really, really good, and I'm really looking forward to seeing what they do with this portfolio, because it does need to turn around. It does a lot of good, and it just hasn't had a good rap, but hopefully that will improve.
Thank you, Richard. Thank you very much indeed for that. That's the end of our bit.